Hello, my name is Cameron Taylor, and today I'm going to be discussing debt sustainability. And this is going to be a discussion and presentation regarding my understanding of Ricardo Reis' journal, Debt Revenue and the Sustainability of Debt. So, why is there a large volume of public debt? The U.S. government has accumulated a large amount of debt over time through war, recessions, and other economic shocks. But a lot of this government debt comes from the fact that the government tries to extend financial assistance and preventing sharp changes in taxes and spending during these kind of economic shocks and events. The government debt also includes financial instruments like loans, bonds, and T-bills that must be paid out by the government after a certain maturity with accumulated interest on that as well. It's kind of is a win-win because it gives the government money to use in the meantime, but at some point this investment does need to be paid out to investors. Another reason why the U.S. has accumulated so much debt is because of international war agreements and involvement overseas. Additionally, tax cuts or delays in the collection of taxes can contribute and be counterintuitive to the accumulation of debt. And additionally, the government debt has accumulated because the government borrows from the central bank and it must pay this money back at an interest. So, to manage and pay this balance, the government will try to reduce and finance what needs to be paid out, and they do so by trying to earn a debt revenue. This is essentially the income that the government receives from lent money, various taxes, investments, and income that's created from seigniorage. The government also leverages its debt, so it tries to make money off of the liabilities and debt that it's holding. The concern with debt revenue is that interest rates have been historically low. We have been pretty close to zero lower bound since COVID. So this raises a pretty large concern about how much revenue is actually being generated from this high level of debt. The government can also manage its debt through fiscal and monetary policy. For example, Congress can change the debt ceiling or they can change the level of taxes, and the Fed can adjust the money supply. Although either one of these methods comes with trade offs and deadweight loss of some sort. So people will almost always want to buy and hold government instruments like securities, bonds, T-bills, and so forth. And the reason why is because these are a guaranteed return, plus they pay the par value. They're extremely safe, so risk intolerant investors like to steer towards these. And they often offer a higher return during economic downturn when the government is in need of funding. The con to these is that they often offer a lower return than that of the market. And they have a lower standard deviation from the mean, meaning that they tend to not be so volatile. They tend to be a relatively fixed interest rate, and you have an idea of your return going into this investment. And generally, you must hold these for a long time in order to make more of a return than you would with a shorter period of time. And to backpedal to the economic downturn, the return is generally based off of the economic climate. If things are expanding and the government is not so much in need of funding, they can afford to, give a lower interest rate so that they're not necessarily making as much. But say during a recession when they're in need of more money, they're likely to charge that higher interest rate so that they can accrue more debt revenue. So investors will generally prefer private financial instruments. If they're looking for something that's safe and relatively secure, they'll likely choose an ETF because they can offer a higher return in a shorter time frame. Private assets are generally expected to be higher than the return of the debt. Economists refer to this gap as the premium, and that is why investors generally prefer these private investments as opposed to the public. But to get the debt revenue, we have to have an understanding of this premium. To get this debt revenue, like the formula, you would need to multiply the premium by the total debt supplied, and that would give you the debt revenue flow. And then from that, you would need to take the expected present value and adjust it for risk. So theoretically, the process of finding the premium does not seem so bad, but in practice, this has been very tedious and hard to do. But this is because these are two completely different kind of investments, public versus private. My first takeaway from all this is that calculating debt revenue is a key function to debt sustainability equation, or we can also refer to it as the debt to GDP ratio. Inaccurate computing of debt revenue leads to an inaccurate estimate of the debt sustainability, which can be largely catastrophic if this is not accurately measured. So this function in itself has methodical issues that are not considerably sustainable. So, fiscal and monetary policy have been the primary tools for addressing the debt balance. However, there's not a single solution to managing or reducing the public debt. But rather, there is probably a optimal mix between the debt to GDP ratio and those kind of measures versus fiscal and monetary policy. So to kind of backpedal to my previous slide, the debt to GDP ratio, it raises these methodological and mathematical concerns. But policies have trade-offs and consequences too. These can raise uncertainty. There is debt bias, where people act in expectation of what's going to happen with the debt. Say, if people assume we're going to default, people will act differently in their purchasing behavior. They will handle their wealth differently, and so forth. Um, these sort of policies, if enacted by the government, can elicit inflation, especially if it's monetary policy, and we're dealing with a raising of the money supply, where price level can go up. Um, we can also deal with a decreased ability for the government to pay off its debt with tax revenues. If the idea is to initiate some kind of fiscal policy that's lowering taxes, this could make it harder for tax revenues to help pay off that balance of debt. So ultimately, spending drawbacks and tax cuts can deepen that debt and make things harder to deal with in the first place. So the concept of debt revenue is promising. If utilized more, it could decelerate debt growth. Debt revenue offers a direct way for the government to service its debt. This revenue could be used to fund public projects, increase welfare, stimulate economic activity, and increase investments, along with easing concerns. So I think that if we utilize this debt revenue function more in mix with fiscal, monetary, and debt sustainability, or GDP to debt ratio, I think that we will have large success. So my final takeaway is that we should use these austerity measures and consider debt revenue's role within this. I think debt revenue is a vital function that we could use, and it's something that we do use to this day, for the government to increase its ability to pay off its debt and make things easier to maintain and manage. I think that this needs to be possibly emphasized more within our government, in addition to monetary and fiscal policy and the traditional austerity measures. But together, I think these seem promising for the economy and that they will decrease public debt or increase our government's revenue. And thank you so much to anyone who listened. Thank you, Professor Walker, for a great semester. I've truly enjoyed this class. If you were just watching this on YouTube, please feel free to look me up and connect with me on LinkedIn. My name is Cameron Taylor. I would love to discuss with you all more about this topic of debt sustainability, but to end the discussion, my apologies, to end this discussion, thank you so much for your time.